Welcome to REI Pro Talk, where real estate investors turn for the latest news, tips, and tricks from the real in the trenches pros. Tune in to hear Chris Goff, the nation's premier real estate investing powerhouse. Join up with other top pros in the investing world as they cover every topic. No fluff, no filler, no holds barred. All you need to know from start to paycheck.
Now, Steve says this is more of a personal question, I guess, but I'm looking at making an offer on a property that I personally want to live in, but I'm a little bit concerned with the market cooling down and what the listed price is. I've already looked at the property. I think that the owner would be interested in terms. So I'm thinking of maybe lease option or maybe a seller finance. But being that I'm a little concerned about the market cooling off and where the interest rates are going to go, would you suggest maybe just sticking with a lease option, or would I go ahead and try to do a seller finance as well?
Me personally, I would always look at the seller finance because I can lock in that particular rate. Rates are going up, but they're still at a historic low. Just keep that in mind. Rates slowly go up and then they slowly go back down, but that could be another 10 years. We don't know, right? And I think that's the gamble that you're talking about. So if you did a lease option and your concern is the market's slowing down, values could come down, and interest rates are going to go up, then I would take lease option completely out of the picture. Because if they're going to start to go up, then you're going to hit that potential, higher interest rate. But just keep in mind that we're still at historic lows with interest rates. So if I can lock in a seller finance with the owner, I can lock in that interest rate. Okay. And depending on how long of a term that you want to go, I would say at minimum go 5 years. So you'll amortize the payments out for 5 years or 30 years, and then we'll do what's called a balloon payment. So if I go into a property here as an example, I'm going to scroll down to step 4. I'm going to go to seller finance. Okay. And this just happens to be filled out, but that's fine. I'm going to put in my sales price. I'm going to put in down payment. Now, you generally will put more money down on a seller finance because you're going to get the deed. I want to try to go low on that interest rate. Okay. So keep in mind that the interest rate and the sales price are going to dictate what that monthly payment's going to be. And then I'll throw in my taxes, insurance. If there's HOA, I could calculate an offer. Now, in this particular example, although I'm only paying $275 for the property, I'm going to amortize it over 30 years with a 5-year balloon. And what that means is I'm going to make payments for 5 years. Now, whatever my balance owed after 5 years, which would be month 60, we'll go down to 60 here. We owe $239,685. This is the balance that I'm going to have to pay the owner. Okay. Now, how do we do that? You could pay cash if you have cash. Most people don't. You're going to go to a bank and you're going to do what's called a refinance. Okay. Because you already own the home. Now, you will potentially be paying a higher interest rate, but keep in mind that's 5 years from now. We don't know what's going to happen in 5 years from now. But at least you're paying it on a much lower dollar amount than that $275. You could also potentially, depending on where this property comps out in 5 years, you might be able to pull some money back out. Okay. Now, although your payments will go up, your balance will go up, you'd be able to take some tax-free cash and maybe take that cash and reinvest it somewhere else into another property. There are some benefits here, and I would say this would be the best strategy going into it if the seller would be open to taking payments for the next 5 years. Okay, so you got to run the numbers on it, obviously. Generally, I can pay a little bit lower price because total received for 5 years would be $353,000 to the seller, not $275, because remember, they're making interest as well. Now, if they have a loan on it, they wouldn't be making that much interest. If they have a 3% loan and you're paying 4%, they'd only be making 1%. Okay. But the way that mortgages run in the US is, as everybody knows, I mean, you look at the first payment, we go to the top here. So we have a $1,700 payment just in interest, $883. So your balance isn't really coming down that fast. And that is a huge benefit to the owner. It's also a benefit to you because you don't have to go to the bank, beg for a loan, please give me a loan, Mr. Banker, right? You can just have it financed through them and then in time refinance that property. Or let's just say for a second, Bo, that you don't want the house in 5 years, then sell it.
Right.
That's the beauty, because you owe 232. You don't have to go refinance that. You could sell it. You could sell it day one if you wanted to. But just as an example, if you went that full 5 years, you could sell that property. You could also use it as an investment property and say, hey, this is a great house, great location. It's not for us anymore. It's been great. Maybe I'll just rent this property out and hold on to it for a long-term investment point of view. And the great thing is that the debt that you have with the owner with seller financing, it's not on your credit report. That's huge if you want to go buy another property and get bank financing. So there's too many benefits in your personal situation. I would see if they would be open to doing a seller finance. They don't have to finance it for 30 years, but we're going to amortize the payment over 30 years in order to keep that payment low. And just say, hey, we'll cash you out on or before 5 years. We'll take care of all the maintenance costs and repairs. We pay the taxes, we pay the insurance, we pay the HOAs, we pay everything. We own the house.
Gotcha.
So hopefully that helped a little
Great
bit.
explanation there.
I know it's kind of a brief explanation, but we only have so much time, unfortunately, with these things. But
now I know somebody might follow up with a question on that, Chris, talking about what happens if they have an existing mortgage on it, the due on sale clause on the wholesaler finance. I mean, if it's a conventional loan, do you even care? You still seller finance it for 5 years?
yeah, it's what we call a wraparound mortgage. You're literally creating a new mortgage wrapped around the existing mortgage, and then you're putting in what we call a subject to financing clause, which basically says, I promise to pay the bank, but if I don't, oh well. Now, obviously, you wouldn't want to do that because then the owner can foreclose on you. You're going to lose the house. Okay. From a bank point of view, as long as they're getting payments on time, they're not going to call the loan due. Banks are not in the business of taking back liabilities. Every dollar a bank takes back in real estate, they can't loan out $3 in credit card loans, car loans, other mortgages, and so forth.
Thanks for listening to REI Pro Talk. If you've ever wanted to jump into the real estate game, get started with the #1 software for real estate investors on the planet, REI Pro. Start for free at www.myreipro.com.